Today we are going to talk about something really interesting. So imagine one product moving from Sri Lankan farmer through processing and distribution into Cargill's outlet and finally into a customer's basket. That journey is not just a supply chain; it's a strategy of Cargill Ceylon PLC. So this podcast examines that strategy using the integrated annual report of the year ended in 31st March 2025. The key question here is how did Cargills grow from a traditional trading company into one of Sri Lanka's most influential food businesses? And can that model keep creating value? So, my view is that strength is the connected ecosystem behind the brand: farmers, manufacturing, logistics, retail, restaurant, and consumers. So, this gives Cargills reach, information, and control across the value chain. The next stage, however, demands better margins, smarter use of data, disciplined investment, and consistently strong execution. So, Cargills began in 1844, but the modern business took shape when the first Cargill's Food City opened in 1983. It then moved beyond retail into processed foods, dairy, beverages, confectionery, restaurants, distribution, e-commerce, and real estate. Today, the group has four main segments: food retailing, food and beverage manufacturing, and distribution, restaurants, and real estate. Its portfolio includes Food City, Cargill's Express, Food Hall, Cargill's Online, Kotmale, Magic, Kiss, Goldie, KFC, and TGI Fridays. It employed more than 10,000 people during the reporting period. The strategic point is that these are not isolated businesses. Retail provides customer access and real-time demand signals. Manufacturing builds local brands and capture more value. Direct sourcing connect producers and markets and can improve freshness. Logistics links a chain while restaurants creates another routes for the consumers. Each activity supports the others. Cargill has built a food ecosystem, not just a business portfolio. So, Cargill's vision is to become a global corporate role model in community friendly national development. Its mission connects food and related businesses to three priorities: reducing the cost of living, building youth skills, and narrowing regional disparities. This is a bold position because it combines national development with commercial growth strategies. This defines success more widely than profit or stock out. Cargills is positioning itself as a national food platform that creates commercial and social value together. We see the purpose in strategic choices: direct sourcing supports rural incomes, improves market access for farmers, and can shorten the route to consumers. Regional expansion improves access beyond Colombo. The Albert A. Page Institute develops employees and future talents. Local manufacturing reduces dependency on imported finished goods, adds value to Sri Lankan, and supports product design for local needs. Purpose therefore shapes the market position, supply chain, people strategy, and stakeholder relationships. That is what gives the vision a practical meaning. Now, let us step outside the company. The environment is improving, but it remains demanding. Sri Lanka returned to the growth in 2024, while inflation and interest rates decline. That supports demand and reduces some financial pressure. Yet the recovery is uneven, and households remain highly value conscious after several difficult years. Cargills must therefore grow volume while protecting both affordability and margin. A difficult challenge in a business where customers notice every price change. The pestle environment adds pressure from several directions: tax, import, rules, food safety regulations, labor requirement, and agricultural policy effect, cost, and availability. Technology creates opportunities through e-commerce, analytics, automated replenishment, and digital training. Customers increasingly expect value, freshness, convenience, health, and trust local brands. Climate risk can disrupt crops, dairy support, transport, water, energy, food waste levels, making resilience a strategic issue rather than only an environmental issue. Competition is equally tough. Customers can choose supermarkets, independent shops, traditional markets, and online platforms. With almost no switching costs, large branded suppliers may hold bargaining power, while individual farmers are fragmented. New vendors need major investment in locations, logistics, technology, and working capital. But substitutes remain everywhere. Rivalry and buyer power are therefore very high. Cargill must combine scale, trust, conventional local sourcing, and a relevant assortment, not compete on price alone. So, what does Cargill possess that competitors cannot easily buy or copy? The answer is not one asset. It is a bundle of connected resources. Its key resources are brand trust, nationwide stores, and distribution, direct agricultural and dairy sourcing, local food brands and manufacturing capability, and deep knowledge of Sri Lankan consumers and supply chains. So individually, each resources is useful. Together, they create a system that can respond from a farm level to the retailer shelf. So VRIO helps to test their strength. They are valuable because they support freshness, access, affordability, and responsiveness. Some are relatively rare, especially the scale of farmer to consumer network. They are difficult to copy because rivals need more than just capital. They need time, trust, producer relationships, location, systems, and operating excellence. So, Cargills is organized to use them through its business units, logistics, trainings, and leadership systems. This combination can support sustained rather than temporary advantage. The strongest capability is integration. A rival can copy a promotion, open a store, or launch a similar product. Copying the entire system, from sourcing to manufacturing to distribution to brands, retail access, and trust, is far harder. So, Cargills is not a pure low cost player. It invests in freshness, quality locations, convenience, sourcing, brands, and community relationships. But it is not a premium niche player either, because affordability is central to the promise. The best description is broad differentiation with best cost characteristics. It serves a wide market and differentiates through access, assortments, fresh produce, trusted local brands, convenience, community connections. At the same time, scale, direct sourcing, manufacturing, and integration help control cost and support competitive prices. This is not the cheapest at any cost strategy. It is an attempt to offer more total value. Put simply, the value proposition is in this: trusted food available across Sri Lanka at a reasonable price, supported by local production and local relationships. This is a difficult balance. Push too hard on price and margins suffer, move too fast toward premium differentiation and value conscious customers may leave. Sustainable productivity is what allows affordability and quality to coexist. Strategy becomes real through action. Cargill has used four major moves to build its proposition. First, horizontal expansion, more food city and restaurant locations increase reach, familiarity, and customer access. Second, backward integration, direct farmer and dairy sourcing improves visibility, freshness, traceability, and producer relationships. Manufacturing also provides greater control over the product development, quality, and value creation. While reducing resilience on outside, suppliers is selected categories. Third, acquisitions. Goldie, Kiss, Kotmale give fast access to categories production assets. Recognized brands and technical knowledge. Acquisition therefore acted as a shortcut to capabilities that would have taken years to build internally. Fourth, partnerships. KFC and TGI Fridays provide global restaurant concepts, while agency distribution expands the portfolio without manufacturing everything internally. Timing also mattered. Cargills expanded beyond major urban centers and invested early in the north and east, creating familiarity and stakeholder relationships before many competitors developed similar reach. That is the first mover advantage built through sustained presence, not simply being first on a launch date. So at corporate level, Cargills is best understood as an integrated food group. More diversification is related. Retail, agriculture, dairy, manufacturing, distribution, and restaurant share customers, logistics, procurement, knowledge, and capabilities. The three corporate advantage tests are useful. First, food retail, FMCG, and restaurants meet recurring consumer needs. Although competition is intense, secondly, Cargills has managed entry costs through internal development. Acquisitions and franchising depend on the capability required. Third, and most important, is the better of test. Do the business platform better together than separately? Diversification creates value only when the answer is yes. In many areas, it is yes. Retail gives products visibility, consumer feedback, and market access. Manufacturing provides differentiated local products, farmer sourcing, strengthens fresh categories, logistics, and information can be shared. While restaurants benefit from food knowledge, supplier relationships, and national familiarity, these are genuine cross-business synergies, not merely just business share in the same owner. Real estate is a less closely related, although it can support destination, locations, commercial development. The main risk is complexity. More businesses require more capital, more coordination, and more management attention. Each one should be judged by strategic fit, cash generation, competitive strength, and return on invested capital. A business that does not pass through those tests may weaken the group even if it continues to grow revenue. So this is where good strategies often fail. Execution. The plan creates no value unless people can deliver it every day across stores, factories, farms, warehouses, and restaurants. Cargill support execution through people, capabilities, and structure. The Albert Page Institute builds retail and food service skills at scale, while digital training can improve speed. While digital training can improve speed, consistency, and reach, separate business units can specialize in their markets while drawing on a common purpose and shared capabilities. The challenge is ensuring that specialization does not turn into functional or business unit silos. Its cultural emphasis service, community, local production, inclusion, and long-term relationships. This supports the strategy by treating farmers, customers, employees, and communities as participants in value creation. Leadership has taken a long-term view of rural sourcing, regional expansion, manufacturing, and skill. These investments were not quick wins. They required patience, and commitment. But purpose is still is not enough. Decision rights must be clear. Information must move quickly across businesses. Accountability must be measured, and rewards must support the right outcomes. Otherwise, diversification can create silos, duplication, and slow decisions. Exactly the weakness that damage strategy execution. So, now for the scoreboard. Did the strategy produce stronger performance in year 2025? Yes. With some courses revenue rose 8.2% to about 241.8 billion rupees. Operating income increased 13.1% to 15.2 billion and net income grew 22.7% to 7.2 billion. The important pattern is that profit grew much faster than revenue. That suggests stronger operating leverage, improved cost control and lower financial pressure rather than growth coming only from higher sales. Margins also improved. Gross margin moved from 11.08 to 11.48%. Operating margin from 6 to 6.27%. And net margin from 2.63 to 2.99%. These shifts may appear small, but in high volume food and retail business, a fraction of a percentage point can create meaningful value. The warning is that the net margin near 3% is still leaves little room for waste, stock losses, or weak execution. Operating cash flow reached about 13.9 billion rupees and free cash flow grew from 36 to 9.4 billion. Debt to equity fell from 1.5 to 1.3 times while invest coverage improves from 1.86 to 3.09 times. The current ratio remained below 1 at about 0.7. Retailers can operate with supply credit and faster inventory movement, but liquidity still needs close control. Overall, Cargills achieved growth, better margins, stronger cash flow, lower leverage, and improved ability to cover interest. The strategy is working better, but thin margin model means operational and financial discipline remain essential. So, what could Cargills do next? I would focus on four priorities. First, choose growth, do not chase it. Major stores, factories, acquisitions, and businesses should face clear tests for return on invested capital, cash generation, and strategic fit. Value created matters more than outlet count or headline revenue. Capital should move toward business that strengthens the ecosystem and earn acceptable returns. Second, turn the ecosystem into data advantage. Connected loyalty, pricing, forecasting, and promotion systems could link customer demand with factories, distribution, and farm supply. Better information can improve availability, reduce waste, sharpen promotions, and make offers more relevant to different customer groups. Third, earn affordability through productivity, energy efficiency, lower food waste, better transport planning, private labels, and sharper assortments can protect customer value while improving margins. Fourth, build a shock-ready supply chain through climate-smart agriculture, multi-region sourcing, supply risk mapping, water and energy resilience, and scenario planning. A balanced scorecard should track financial returns, customer value, availability, waste, farmer outcomes, employee capabilities, and environmental resilience. This connects strategy with everyday performance. What gets measured consistently, reviewed openly, and assigned to a clear owner is far more likely to be executed. So, the final judgment is clear. Cargills is not simply expanding supermarkets, it is coordinating a Sri Lankan food ecosystem that serves commercial and national development goals. The strategy fits Sri Lanka's need for affordability, convenience, trusted local production, and reliable food access. Internally, it is supported by brand trust, nationwide reach, producer relationships, manufacturing and operating knowledge. Related diversification and vertical integration create real strategic fit. In the year 2025, this strengthens and judgment, revenue profit margins, cash flow and interest coverage all improve. The strategy is sound and execution is moving in the right direction. The next chapter will be harder. Cargills must convert scale into stronger returns, relationships into resilience, and its operating network into true data advantage. It must also keep the different businesses moving as one system rather than separate silos. If it can do that while protecting affordability and purpose, it can remain a strong business and become one of Sri Lanka's best examples of strategy creating value for customers, farmers, employees, shareholders, and the country. Thank you.